Hello, everyone. Welcome to this exclusive session with the fund manager of Edelweiss Financial Services Fund, Mr. Ashwani Agarwal. In this session today, we'll be discussing the the ongoing NFO about Edelweiss Financial Services Fund. We'll explore the investment opportunities in the financial service sector, and we are honored to have you, Mr. Ashwani. So, Mr. Ashwani has spent
Thanks a
more
lot.
than, thank you. Mr. Ashwani has spent more than 20 years in this industry in investment banking, and he is also a CFA charter holder and has done his MBA finance from the very prestigious institute, TAPMI. And we are happy to have you here with us today. Wishing you all the very best for ongoing NFO. And
Thanks a lot.
we would like to ask a few things about the ongoing fund, and let's just start with the investment strategy itself. Mr. Ashwini, how does the fair investment framework guides your investment decisions in the financial sector, and how do you identify these attractive value opportunities here?
So, if we look at the FAIR framework, the first thing is forensics. We don't want any kind of a leakages in profitability from the company from any of the angles. Hence, we conduct a forensics and before we start investing or before we get the stock in the universe. We study the normal annual report which is there, and we look at various data points which are outside the annual report. We do our channel checks, and we ensure that there is no problem with the promoter or his running of the business, and there are no leakages whatsoever. Because any kind of a leakage would be detrimental for the investors in terms of both earnings and multiples. So that is the most important for us. We look at the robustness of the business because we don't typically look at a quarter play or something, but a business where there is a moat which can have a good runway for next decade or two, considering the demographic profile of the India or overall demand scenario. There we invest, and the thought process is very clear that the return ratios or the ROE should be more than cost of equity. Or I think that it should be going to be more than cost of equity in next 1 or 2 years. Secondly, the PAT growth or the profit growth should be more than nominal GDP or sector leading profit growth. Thirdly, the company should be generating cash flows on its own from operations. I do understand that if you're a startup or a high growth company, then you may require more debtors or more to be invested in the inventory. But in the long run, you should be making cash flows to the tune of at least 60 to 70% from your operations itself. So, and fourth, as I said, forensics. So these are the four very important tenets of our investing. And most of our investment is done, rather all the investment is done keeping these four frameworks, or this is like an umbrella, that you have to take these four things as an umbrella and then you have to invest. And fifthly, valuation should be in my favor. I do not want to overpay for anything because if you invest in a not so great business and overpay, remember that that money is not coming. That may be some sentiment wise euphoria for the time being. And even in the good businesses, we don't tend to overpay. We try to err on the side of caution. This is the way or the very basic way we invest, and that is we have been following and would like to follow.
So good to know that. And now that we know about the what is the framework behind this ongoing NFO, how do you really plan to allocate assets across different segments of the financial sector, such as banking, insurance, and NBFC? So, what would be your take on this?
So if you look at, we have the entire financial sector, we have divided it in four segments, sub-segments. The first one will be the lending category. That would consist of NBFCs, private and PSU banks. The second would be capital market players. The third would be insurance players, and the fourth would be fintech. So if you look at the global scenario, especially in the developed markets, the capital market have a larger weight in their entire financial system. as compared to India, where we have banks or the lenders uh, driving the entire valuation currently. So going forward, as we see, if you look at the overall demographic profile, the product under penetration or penetration levels, I think banking sector will, or the overall financial sector would do fantastically for next 2 to 3 decades. So that is a kind of a runway we are looking for. Within the financial sector, I think the contribution from the banking sector would go down for the next 5, 10, 15 years. And the contribution of NBFCs, capital markets, insurance, and fintechs would keep on increasing. And that is how we will position our portfolio, that we would want to play growth and ROE, because India is a growth story. Now, if you look at the capital markets, the main story of capital markets has started in last 10 years. If you look at mutual fund industry, we started way back in 1964, but most of the mutual funds came from 1993. And from 1993 to 2020, we reached an AUM of roughly 21 lakh crores. And today we are standing at 80 lakh crores. So what have we achieved in 27 years or 28 years? We have done 3x of that in the next 6 to 7 years. So that is the kind of a growth which has happened in 6 to 7 years, just because people realized that investing is not buying shares today and selling it within a month, 2 months, 6 months. It is like a long haul play where you buy, invest in a mutual fund or a stock, and then remain invested for 5 to 6 years, where you make a good sum of money. And earlier, most of the savings in India was either in real assets, gold, pension funds, or FDs. So if you look today, just considering 11 to 12% returns from Indian markets, equity gives you the money doubles roughly in 6 to 7 years. But if you put it in FD, where you don't have the tax advantage also, the money doubles in roughly 14 to 15 years, 12 to 14 years to be precise. Keeping a higher rate in mind, then I would say 12 to 14 years. So here equity is beating all the asset classes in financial assets hands down. So people are realizing that as more and more financial literacy comes in, and the new generation starts investing, and they are much more literate than the earlier generation. So I think there is a good runway. Even if you look at the insurance space, either we are usually underpenetrated, and whoever has got insurance is underinsured. So again, as I say, looking at the demography, increase in per capita, and overall financial literacy, again, 2 to 3 decades of stable demand is there. And fourth is the fintech. We have seen this segment come up in the last 10 years. This fintech has changed the way we do business, the way we live. If you remember something 15, 20 years back, today we just do our payments within few seconds. Earlier, we had to go to that place, stand in the queue, make payments, wasting 2 to 3 hours. And in the next 5 to 10 years, a lot of these wallets, payment banks, and the new age businesses who are disrupting the market will come for listing. So we'll tend to invest in all these segments. Don't hold on to me the asset allocation. Roughly 60% plus minus 10% would be in banks, and the rest 40% would be in the other segments. But the system is very much changing. Economy is very much changing. And today, all the things are, there is a lot of geopolitical upheavals. So yeah, the allocation may change for a tactical purpose, but my main idea would be to invest in growth companies and make money for the investors.
Great. So good to know that ratio of asset allocation, and given all the factors which you have stated here, especially fintech, this makes a perfect runway for the new fund offer. Also, this is a question which also came from our partners. A question everyone is super curious about. So, given the recent underperformance of the financial sector, what are your expectations considering it might impact the fund's performance, and what would be your growth prospect from the sector overall?
So if you look at for the last 15 years, from 2011 to 2025, only in 2 years, the sector has given negative returns. That is 2011 and 2015. It was because of creation of huge NPAs or cyclical. Otherwise, it has given positive returns. And the sector has underperformed from 2020 to 2024 because there was a lot of fiscal stimulus which was given by the government and the state governments. So if you look at the other sectors, they performed then, and that's why the BFSI sector didn't perform. If you look at capital goods, utilities, industrials, infrastructure, they did really perform very well in 2000 from 2020 to 2024. But from 2023-24, as the fiscal consolidation started, the other sectors started to lose the sheen. And in 2025 was a turnaround year for the financial services, where it generated a return of roughly 22%, 20% against a negative 2% return of a Nifty 500. So here in this year, 2025 itself, we have seen the inflection point, or rather the turning point of financial services, where it outperformed the overall index by roughly 22%. So from now onwards, if you see, we don't have much fiscal stimulus going on. Whatever is there would be there in terms of consolidation. So I think we have a good runway. If you look at the inflation is eased out very clearly. It was 6.5%, 7% 2-3 years back. Now it's up 2%. Interest rates have come down, and your credit growth has started to pick up. Liquidity is ample in the market, roughly. So all these four things really bode well for the performance of the financial sector.
Definitely. Considering that we're expecting a good performance going forward, but still, what are the key risks and challenges facing the financial sector, and how do you plan to mitigate them?
So if you look at, I really don't think there are big immediate challenges. If you look at overall profitability, balance sheet, or asset quality of the financial sector, especially the PSU or the private banks or the NBFCs, they're in the best of the shape in the last 15 years. Even the corporate leverage has come down drastically, and even their balance sheet is the best in the last 15 years. So apart from geopolitical system or the global geopolitical system, I don't see a huge risk as of the Indian banking system. If you look at, there is political stability, economic stability, the currency has become stable, inflation is stable, interest rates are stable. So I don't think that there is any domestic factors which can create any risk to the system. But yes, if there is any problem with the crude, if it inches up or the commodities run up, then we are net importers of commodities and crude. So that will increase the inflation, and then interest rate which have been, or the inflation which have been lower, or the interest rate which have been lower may have to be increased. And whether interest rates are increased or not increased, higher commodity prices are not good for our country. So this is the geopolitical risk which I think is there right now. Otherwise, I think we are in the best of the shape.
Good to know that. Also, my last question would be, what are the key differentiators of this fund if compared to other financial sector funds, and how do you expect it to, perform in a longer term?
So if you look at this fund, would cater more about alpha generation, less of benchmark hugging, and maybe more oriented towards lower large cap exposure. I would say that. And I wouldn't really go very aggressive in generating returns, but I would think consistency is the key behavior in generating returns, especially from a 5-year window. And for the next few years, definitely I expect the BFSI sector to do well. Well, we don't talk about how much we can generate, but yes, it is likely to do well in the next 5-year scenario, considering that we are in the best of the macro situation currently, and other situations are also in favor. And the deal already has been done between India and US. So that is again a welcome sign. And if you also look at the valuations, the valuation of the entire BFSI category is lower than the average of itself of the last 8-9 years, and significantly lower than the other sectors as well for similar growth profile and return ratios. So I would clearly say that there would be some re-rating of the stocks, and it will follow the earnings growth.
Great to know that. So from as the NFO tagline itself says, from cash to clicks, India's financial habits have evolved. So wishing you all the very best for Edelweiss Financial Service Fund new fund offer. Thank you so much, Ashwani ji, for sharing your valuable
Thanks, Yogita.
insights. Yes. For more information, we would request the audience to please refer to the brochure and presentation. And thank you for your precious time. Wishing you all the best.
Thanks. Thanks again.